Okay. Hi, everybody. My name is Andy Kizik, and I'm a Senior Vice President at OTC Markets. And welcome to our first Thought Leadership webinar for 2021. Today, we will be addressing the cannabis capital markets. And just a couple of items in housekeeping before we get started. We are in GoToWebinars. The format of this meeting will be that our guest, Scott Greiper, and I will have a presentation discussion, and then we will go to questions afterwards. If you are a participant and would like to post a question, you can do that in your chat box, and then we will try to get to the questions at the end. That is the general housekeeping. Everybody will be on mute. So welcome to the Thought Leadership Series. Our guest today is Scott Greiper, who I've known for quite some time. Scott Greiper is the founder and president of Viridian, which is a pioneer investment bank in the cannabis space for close to a decade. Scott's experience goes back 20 plus years in investment banking, mergers, acquisitions, and financing. And before I introduce Scott and let him speak, I remember having a meeting with Scott probably around the time of 2013, 2014. And he came to our offices and said, this is going to be an industry. We're pulling it together. And bootstrapping this all together has been remarkable. So with that introduction, I want to turn it over to Scott to initiate our webinar on the cannabis capital markets in the state of cannabis today. Scott?
Andy, if you're going to keep saying nice things about me, I'm just going to ask you to keep going.
Well, listen, I'm from New York. It might not last long.
There you go. I am too. Well, thank you. Really happy to be part of this with you, Andy, and thank you to Josette for all her help in pulling this together. We've known each other a while, and proud to have Viridian Capital and our broker-dealer, Bradley Woods, be a member of the Premium Provider Directory service of OTC Markets and an investment banking partner to OTC Markets. It's critical. You know, you have become the go-to place as an exchange in the US for listing cannabis operators, both those that touch the plant and those that don't. And it's needed because when we started our practice in 2014, you know, there were virtually no publicly listed cannabis companies, and it's all sort of exploded in the interim. So really appreciate the value that you bring, Andy, and OTC Markets to the cannabis industry. We believe, the first licensed investment banking practice in the industry. We launched in June of 2014. The team has done about $750 million worth of transactions, capital raise, both debt and equity, M&A, buy and sell side. We've done scores of advisory assignments, which are valuations, financial forecasting, M&A strategy. And I think many of you on the call, I hope, are subscribers to the Viridian Cannabis Deal Tracker. Andy, I know you received that, which is the only database of its kind in the world that since 2015 has been reporting on all of the capital markets activity in the industry. Capital raising, public and private, debt and equity by sector, by state, by country, and the same thing on M&A. So we're happy to be part of this with you, Andy. I think it's an incredibly interesting time in this industry. I mean, we're coming off of a 2020 year, which was just a roller coaster. You know, we went through January and February of 2020, really a year-long decline in valuations, in public cannabis company stock prices, a major decline in capital availability, a virtual slowdown in M&A, really all starting in the second quarter of 2019, when public cannabis companies in Canada and the US started to report first and second quarter 19 results that came in well under analyst estimates. And that started, as I said, almost a year-long decline and the first significant correction in the cannabis industry. And who knew? Nobody knew that this global pandemic that really started to affect the US in March of 2020 would be a prime lever, a prime driver of the recovery in the cannabis industry. You know, most of the states, as you all know, red and blue, deemed cannabis as an essential product, an essential service. Cannabis companies started reporting record results, sales at the dispensary level. All of a sudden, the public companies started beating analyst estimates, and it pulled us off or out of this trough. Nobody could have forecasted that, but in fact, that's true. And the recovery allowed a second source of financing to come into the industry. Andy, I know we're going to talk a little bit more about this, but you and I both think this is critical. 2020 saw the emergence of the lender in the cannabis industry, of debt financing in the cannabis industry. Prior to that, we saw almost no debt. Well, we saw some really ugly convertible debt, toxic convertible debt, floorless convertible debt back in 15, 16. That wasn't real debt. That wasn't growth capital. That was desperation financing. 2020, two of the largest capital raises we saw, in fact, the two largest that we reported on were debt financings. It's an important sign of the maturation of this industry. M&A has returned to the market. You guys are seeing that in the last couple of months of 2020 and certainly the first month of 2021. Andy, your companies, the cannabis companies that trade in OTC markets, had an incredible year in 2020 in terms of raising capital, in terms of being aggressive M&A acquirers. The legislative environment with the Democrats winning the White House and the Senate is certainly providing an underpinning for the institutional investor to come into the market, which they did at a higher level in 2020 than we have seen previously. So what a wild year and in 2020. And now we're starting 2021.
It's been a great year. And I think what's interesting, and just before we dive into the established credibility of debt financing, you know, the bootstrapping that took place in 2014, 15, and then a takeoff in 16 has led to a tremendously large number of companies. I mean, today, OTC markets on our premium QX platform and QB platform have over 200 issuers alone in the space, many of which are quoted in Canada, but the secondary quotation is available in the US, allowing for real-time trading in US dollars. And, you know, here we are in 2020, we have debt financing, coupons, creditors now. And when we look at that, I'm curious to hear from you, Scott. And by the way, just for everybody's benefit, this presentation will be available in email to all those who registered, and it will be also, this recording will also be available on our website and distributed to you. But what I want to get to with the debt investors is, you know, I want to know a little bit more about, tell me a little bit about the evolution or the demographic of investors that now have an appetite for the cannabis industry, and where and how you see that kind of coming in through, I don't know, maybe 2019, 2020. Can you give us a little demographic on the investors, Scott, that you've seen?
Yeah, for sure. You know, when we started in 2014, Andy, there was no institutional participation in this market. It really wasn't until Peter Thiel from Founders Funds invested in Privateer, which was in 2015, and subsequently Privateer became a large investor in Tilray. That was the first institutional investor in this market. But even in the intervening years, we saw a very, very low level of true institutional participation. private equity, venture capital, mutual funds were virtually non-existent. They viewed this industry as an underground industry. They viewed this industry as a federally illegal industry that could be convicted or accused of money laundering. It was really the family office investor, at least for us in the companies we raised capital for in our early days. It was the family office investor that was, I'm using air quotes here, the professional investor in the market. And that was the case for some years. Last year, that changed. And it changed in a couple of different ways. We saw the emergence of cannabis SPACs, the Special Purpose Acquisition Corps. There were 18 of those that came public in 2020 and the last part of 2019. They raised almost $3 billion. 9 of those did a traditional underwritten IPO on NASDAQ in New York. The average SPAC, cannabis SPAC, raised about $210 million. Those are not retail-driven deals. Those were institutionally driven deals. Now, many SPAC investors invest in SPACs because it's a trade for them. They can sell out of the common, they keep their warrants, they get a free ride. But nonetheless, those are funds. Those are SPAC funds that came into the market. Haven't seen that before. And we just uncovered, as did others in the industry, that the mutual funds, the Fidelities of the world, Putnams, Wasatch Advisors, disclosed through public filings that they had taken positions through the public markets in 3 of the largest publicly traded multi-state operators. We haven't seen that before. You could see that, by the way, in the underlying trading characteristics of some of these larger MSOs. Tremendous uptick in volume, tremendous uptick in daily dollar volume. So the institutions are starting to come in. And just to finish off the answer, Andy, then came the lender. And I'm not talking about the guys doing toxic convertible notes where they actually make money as stocks go down. I'm talking about traditional lenders that either came into the market as an offshoot of a larger debt fund, and they were starting to focus on cannabis, or the preponderance of cannabis-focused debt funds that started to come into the market last year. Here's the bottom line on that. Lenders lend to companies in which they have confidence that their coupon's going to be paid on time and that they're going to get repaid at the end of the term. That requires a mature company that has consistent and visible cash flow to service the debt. That didn't exist in the cannabis industry until really the end of 19, beginning of 20. And it is a very positive sign of the maturation of the industry, of the fact that some of these larger companies, particularly the public companies, who have absorbed the majority of capital coming into this industry, almost 85 cents of every invested dollar last year went to the public cannabis company. But the lenders started to see that there was maturity in operations, in governance, consistency in revenue growth, and consistency in cash flow. So the investor in the industry has matured along with the maturation of the industry.
This is really encouraging to me because in my experience, when I've seen the evolution of vice stocks, whether they're alcohol, tobacco, and now cannabis, we never saw the likes of the Fidelities, Putnams, and the Wasatch reviewing this market as it does today. I mean, you know, OTC Markets operates a cannabis index, which you can track on our homepage. Since January of 2020 till today, it's, aside from the correction in March of earlier this year, it went from 400 virtually down to 200, and then it shot up to be at about 818 points. And this is just a tracker. It's not an investable piece. And it discloses the top 30 constituencies, which include, you know, Curaleaf, you know, Althea, Cresco, et cetera. You can see it on the site. What's interesting to me is you have a Canadian listed issuer and a US issuer, and the investor has a choice of where to purchase the shares in either market, wherever it's more suitable for them to purchase it. You know, I want to get in a little bit into the corporate governance suggestions that you have for issuers who are seeking to build and try to reach that expanded investor base, you know, hit the Fidelities, the Putnams, the Wayside for their particular companies. We have a lot of participants on this call who are operators, and maybe you can get into a little bit of what you've seen work in the space. Can you give a little color on that, what you've seen and the direction it might be moving towards?
Yes. Let me ask you if you could go to slide 9 of our presentation, so we can have the listeners actually start to dive in. This presentation will be made available to everybody, but here's the chart, guys, and this is going to be part of my answer, Andy. This is what we were talking about in terms of the emergence of debt. You could see that the capital markets, in terms of capital raising, really began to recover at the, let's call it March, April, May of last year. That's the impact from COVID. I mean, there's no question about it. The impact of COVID on the record sales for cannabis operators. Okay, but if you look down on the bottom of the numbers, and I'm not going to take you through all this, guys, but two things. There was less capital invested in the industry in 2020 than 2019. We did not recover from the downturn that began in the second quarter of 2019 and went into the first quarter of 2020. Even with COVID, even with the Democrats winning on November 3rd, 2020 was still a down year in terms of transactional activity for capital raises and M&A. However, what these numbers also uncover is that in 2019, about 25, 26% of all capital that came into the industry was debt. In 2020, that number was closer to 37%. Just to prove the point that this is not fantasy land. The numbers prove that lenders came into the market. I want to go back, if you could, to slide 6, please. Your companies that list on OTC, Andy, broke that trend. And there's a couple of reasons for it. You had many more cannabis listed companies on OTC in 2020 than you did in 2019. So it's not apples to apples. But if you look at the number of raises by OTC listed cannabis companies in 2020 versus 2019, you could see, there was a 6.5-fold increase. If you look at the amount of capital raised in 2020 versus 2019, there was a 13-fold, whatever it is, about a 9-fold increase. The only decline we saw was in M&A. M&A is a lagging indicator to capital, at least in this industry, probably most, because the primary acquirer in the cannabis industry, since the beginning of the cannabis capital markets, which really kind of started in 2014, 15, when we saw the first companies go public, the first US companies go up to Canada to go public or do an RTO. But M&A trails capital because the primary acquirers in this industry, almost 90% of all the acquisitions, since we started tracking this in January of 2015, has been the public cannabis company. They have the stock that could be used as consideration for an acquisition, so they're not all cash buyers. And they have the balance sheet to be an acquirer because they have a better ability to raise capital. So we've only started to see the recovery in the M&A side of the industry in a little bit of November of 20, a little bit more of December of 20, and it's just exploded this year. Why? The public companies, particularly the larger MSOs, are back to historically high stock prices. So they're a better buyer and able to use their stock as currency. And as you guys have seen, those of you who get the Viridian Cannabis Deal Tracker or otherwise, the amount of capital being raised in the industry in the last 60 days is above where we were a year ago. So we really are into this recovery, and the OTC companies are leading that. With that as a backdrop, Andy, let me finally answer your question. So why does the preponderance of investor capital in this industry go to the public company, and particularly the larger cap public company? What is it about those companies that investors are drawn towards in making a bet in cannabis? Well, we'll make the claim that despite the recovery in the cannabis industry and the cannabis capital markets, we're still in an environment of fear, of uncertainty, of a pandemic, of a change in administration. And investors in any circumstance, you can look back decades, fear and uncertainty drives investors to safety and liquidity. Now, I'm not claiming that cannabis is a place to put your money because of safety and liquidity. You put your money in cannabis because it's one of the world's fastest growing markets. But within the cannabis industry, the larger public companies do offer, on a relative basis, safety and liquidity. Safety because they're public, they have a better ability to raise capital, they have a better ability to attract strong management, build better boards of directors, have better capabilities for execution and operation. And that's sort of the safety side to an investor saying, okay, I'm going to bet in the industry, but I'm going to just invest in the larger companies because they have a better ability to shepherd and invest my capital to drive a return. And then the liquidity side is obvious. The best liquidity in this industry is the larger cap companies. So liquidity in terms of daily volume, daily dollar of average daily dollar volume. And we're seeing that in the larger companies. So, when we get called to assist a company, capital raising, they want to raise debt or equity, they want a valuation, they want to buy or sell. We look at management, we look at the board, we're looking at the ability for institutional level forecasting, modeling. We will not come into a company if there's not a board of directors in place where there's independent members of the board that have very defined roles, whether that's a director in terms of budgeting or administration or HR or compliance. One of the things we brought to this industry was we build boards of directors for our client companies. Because if a company does not have independent members of a board, it doesn't have governance. And that's starting to come into the industry just in the last couple of years. We've taken now 5 or 6 members of the Viridian board and gotten them nominated to the boards of our client companies. Oftentimes, they're the first independent members of the board of our client companies. These are folks like the former president of Diageo, the largest beverage alcohol company in the world, or the former president CEO of Condé Nast, one of the largest advertising marketing companies in the world. That's what we bring in addition to investment banking. So real governance, proven execution, strong balance sheets, and management that, at least in our eyes, Andy, brings to the cannabis industry success in other industries. So the profile of our CEOs of our client companies, they come out of ag tech, they come out of biotech, they come out of the big brand world, they come out of real estate. These are industries that are very, very tangential to the cannabis industry. They're branded consumer product industries. Some of them are very highly regulated industries like the cannabis market is. So, we have financed both private and public companies, and you find this excellence in management, operations, execution, governance, forecasting, modeling, keeping a tight rein on your cap table so you're not always diluting owners and shareholders. This is what makes a great company. And in the last couple of years, we've seen this start to percolate in the cannabis companies. And I think ultimately that's the reason why you're seeing the institutional investors start to come into the market.
So we've seen some really good foundation changes in corporate governance. And we've talked a little bit about the industry and market in 19 and 2020, and now we're kind of moving into 21, maybe we call it in a gangbuster mode. Tell us, who are the best positioned companies and sectors looking into 2021 based on the analysis that you've had? What do you see happening into this calendar year? And I would also like to add to that, we have a new administration coming in and its potential effect on the cannabis business and investors. How do we start looking into 2021, and what should we be looking at and looking for into this calendar year?
Can I ask you guys to go to slide 11 as a backdrop for responding to that question?
Okay, there it is.
Okay. So guys, I know this is a little bit difficult to read, but in answer to Andy's question, I kind of want to give you the evolution of how capital has come into the industry by sector, because this is not a flat industry. It's not only an industry that's state by state in the U.S., at least for the licensed operators, but it's also an industry that really has 12 distinct business sectors. We put out this analysis, not this one, but we put out the first kind of landscaping of what the hell is the business of cannabis? Is it growing? Is it selling? Is it infused? We came out with this in late 2014, where we identified what we at least believe were the 12 different business verticals in the cannabis industry. It's only changed once in the intervening 6.5 years, and that's the addition of hemp as one of these sectors after the passage of the US Farm Bill in December of 18. So when we track all the deals and we put it into the deal tracker, we also allocate it to the sector in which the deal occurred, whether it's capital raise or M&A. This is the look of what happened in 19 versus 20. I'm just going to make a couple of points in answer to your question, Andy. Since the beginning of the deal tracker, January 15, the one sector that has captured the preponderance of investment capital and that has been the most aggressive sector on M&A, both buyers and sellers, has been cultivation and retail. The licensed supply chain starts with growing, processing, manufacturing, distribution, and the dispensary. Okay, it's no surprise that this sector captured most dollars, because in order for cannabis to be produced and infused and sold, you have to invest in infrastructure. It's the infrastructure of the supply chain. So no surprise. What is a surprise, not a surprise, what is an evolution is the sector rotation we've been seeing and reporting on. So you can see cultivation and retail was 39% of all capital raises in 2019. And it jumped to 45% in 2020. There was a slight increase in the amount of money going into cultivation and retail. But the two sectors that showed the largest growth and that are setting themselves up well for continued growth this year for investors were biotech pharma. You could see it there. Biotech pharma went from 22 transactions to 46. It went from 4% of capital raised to 15% of capital raised. Why? The medical side of this industry needs science. It needs clinical trials, it needs observational trials, it needs R&D. And other than the fact that the University of Mississippi since the mid-60s has had the only DEA license to buy seeds, grow cannabis, and test, the DEA in 2020 started to expand that. And there are now upwards of another 30 licenses that are going to be awarded to medical companies, universities, think tanks, hospitals to actually run clinical trials, observational trials to determine the efficacy of cannabis. It's critical. We invested in one of the larger companies in Israel that's a leader in medical cannabis R&D. We invested about 2 years ago. Israel really took the mantle of cannabis R&D away from the US because the US wasn't allowing it. We started to allow it last year, and that's starting to increase meaningfully, thankfully. The other areas we're seeing capital coming into is infused products. Many of you have seen, whether it's from MJ Biz or it's from BD Analytics, the fact that there's a continued increase in purchasing of infused products, and we've seen this now for 4 years. I believe in 2020, we had the highest level of sales at the dispensary level for gummies and infused drinks and infused chocolate bars and tinctures and the like. The consumer consumption of cannabis has been moving towards infused products for some time. We're still seeing capital coming there. Why? Because this is a consumer branded industry. Even though there are not many nationally known cannabis brands typically dominate or have leading market share at the state level. That will evolve over time. And you're starting to see more capital coming into brands. We saw the first brand companies come public in Canada in 2019, Charlotte's Web, Slang Worldwide, and of course I'm forgetting the third one, but that's continuing to start to evolve. So the brand side of this industry and the people that are coming in from the biggest brand companies in the world are driving investments in brands. This is a consumer products industry. We at Viridian just announced a couple of days ago, the newest member of our advisory board, who was the general counsel in charge of IP and brands at Mars Wrigley, the largest snack food company in the world. He held the same position at SmithKline Glaxo. So you're having people that are coming from the largest brand companies coming into the industry, and it's about time. So we see biotech pharma, we see the brand side of the industry, we see cultivation and retail, and lastly, software media. You guys on the call, I'm sure, have seen this, but there has been an explosion in the number of ERP software companies coming into the industry. It's not just QuickBooks. There are companies coming in that are standardized on top of the Microsoft Dynamics CRM platform. One of the first companies to de-SPAC, one of the first SPACs to de-SPAC was Akerna. They acquired a cannabis ERP seed-to-sale software company. So as these licensed operators start to grow, start to reach across many states, start to deal with more consumers, there's a need for more of an institutional way to manage the business. Whether it's inventory management, HR, merchandising, accounting, purchasing, this can't be in a general ledger or QuickBooks. So they're emerging to more sophisticated platforms. And as a result, whereas software media represented less than 8% of capital in 2019, it was 11% last year. So those are four of the sectors that we see, because we follow the money, investors starting to move into.
So if we see the maturity of this space.
Andy, let me just leave it with one more thing, if I could. The sector that got slammed last year was hemp. Look at hemp. 53 capital raises in 2019, 8 last year. This exuberance following the Farm Bill in late 18 of a federally legal CBD product, hemp-derived CBD versus cannabis-derived CBD, that could be sold in Whole Foods and 7-Eleven and thousands of convenience stores because it was federally illegal, has busted to a large degree. And it busted because states over-licensed on the cultivation side of hemp, they under-licensed on the processing side of hemp, and as a result, you didn't have product coming to market. We had 2 major bankruptcies in the hemp side. You guys know who they are. So you have to be careful as an investor, we believe, in sort of the maniacal side of, you know, what people thought in 14 and 15 was the green rush, and everybody's going to get rich on weed. And in fact, that's not the theme of this. The theme is execution, operations, good balance sheet, good cap tables. And hemp has gotten really nailed. It'll work its way out over time, but if this industry is not equal across all sectors, which is why we track the flow of capital by sector, because there's a current sector rotation going on right now between where investors are placing their bets.
Thanks, Scott. So while you were speaking, I was saying to myself, with the maturity of this industry, we're going to see some consolidation. And, you know, how can investors and/or corporate issuers capitalize on what we could potentially see as an increasing pace of the M&A activity in the cannabis industry coming into 21. And, I want to come back to the new administration coming in. Would we see a more favorable part of the acceleration of that industry? How can we tie that together? What do we forecast, or what are we seeing for the M&A activity into 21 as the industry matures? And will that be accelerated by the new administration?
Yep. Can I ask you guys to flip to slide 16, please? So we track, again, within the Viridian Cannabis Deal Tracker, M&A by sector, by buyer, seller, by country, by state. And we also break down the components of these deals. So how did the acquirer buy? What was the stock? What was the cash component of consideration? What was the stock component of upfront consideration? And then what were the terms and tiers of earnouts? We follow structural issues and valuation issues because not every buyer buys the same, and we represent companies for sale. So we have to know this stuff. So here's sort of a summary or aggregation of the acquirer side of the M&A industry in cannabis last year, 20 versus 19. And what you're going to see is what I kind of had mentioned before. Cultivation and retail has been the cultivation and retail company, the licensed state operator, has been the primary acquirer in this industry since we began tracking this. And if you go to the next slide, please, 17. Here are the targets. Here's what the buyers bought. Cultivation and retail has been the primary target for acquirers. So the cultivation and retail operator has been the acquirer and the seller as companies look to build scale across states. That's going to continue because the MSOs and the public and private MSOs are the better capitalized companies, and their whole model is acquisition, right? You're scaling across different states. Where we're seeing it start to change, Andy, in answer to your question, is in a couple of ways. First of all is the emergence of the SPAC. Okay, the SPAC is an acquisition vehicle, purely only. It's not an operating business. It's the modern version of the blind pool. And these companies capitalize, they go public, they raise IPO money for only one reason: to make an acquisition. What's interesting is because all of the US cannabis SPACs trade on either the New York or NASDAQ, they cannot acquire a state licensed plant touching company. The exchange won't list it. They won't allow it. So these buyers have to buy on the ancillary side of the house. So what has that been? It's been brands, it's been software companies, it's been real estate companies, it's been software companies, I think I just mentioned that, and it's been infused products companies. So all of a sudden, the targets for acquirers in this industry, which have been primarily state licensed private operators that we're getting scooped up into public and private MSOs, that's changing because the 2.9 billion raised by the cannabis SPACs in the US cannot buy a state licensed operator. It's been a boon for our clients that we represent on the sell side and the industry in general that are not state licensed operators. All of a sudden, they have these very well-funded public companies that trade on senior exchanges that have to buy the non-plant touching side. That's one way that this has changed into 21. I'll give you one other example. The SPACs are not the only consolidation platform that has emerged in the cannabis industry. As many of you know, over the last 2 years, 2.5 years, there's been a number of groups, primarily funded by private equity, family offices, that have created holdcos, okay, acquisition vehicles, typically private. These are not SPACs, they're private. And they're funded, and their strategy is to consolidate a sector of the industry. That's their model. And then ultimately, once you develop a portfolio of enough companies and you properly integrate those companies, you can take that public or you can sell it. So these have been acquisition vehicles that are private. What have they been acquiring? They've been acquiring hydroponic companies. So these are the companies in every state. You grew up with one near you that sell, Christmas trees, and they sell gloves, and they also sell to the cannabis state licensed operator soil, nutrients, racking systems, grow lights, CAD/CAM systems, extraction technology. They've boomed. And Scott's Miracle-Gro was really the first acquirer in that space. We just sold the largest independent hydroponics company in the industry. So the hydroponics sector is being rolled up. The brand sector is being rolled up. The software sector is being rolled up. The point, Andy, is what's changed is that it's not just cultivation and retail buying cultivation and retail. We're starting to see the acquirers, both public and private, look at the non-plant touching ancillary companies. That's going to continue through this year.
Thanks for that. I'd like to encourage at this time some of our audience, if they have any questions, to put them in the chat box. I think that, Scott, as we continue, I think we've talked a lot about it's a topic that we can go on for a while, but I think one of the things that's going to be a concern is what are the main things that can go wrong at this stage related to the current upswing in cannabis capital raise. What's the things you're going to lose sleep over, or what's the red flag that you're going to be looking? Maybe you can give us some insight on that.
Yeah, this is going to be a really boring answer because it probably applies to every company and industry in the history of the world. Clearly, the legislative environment is the best it's ever been for this industry for all the reasons you know. Democrats win the White House, Democrats control the Senate of the House. God willing, the Safe Banking Act will get passed. It's passed the House 2 years in a row, never got to a vote in the Senate. I think it's going to get passed. I don't know the timing on federal legalization. I think that's a little bit in the offing. Certainly we'll see some levels of decriminalization. So I think the risk from a legislative perspective, which is what has been the main impediment for the institutional investor to get into this industry. Because at the end of the day, and I know this firsthand from representing private equity firms, speaking to the largest law firms, the concern is you invest in a company. Let's say you invest in a state licensed company, you pick the state. There is rationale for that company's revenues to be accused of being driven by money laundering activities and aiding and abetting in the production and distribution of a federally illegal narcotic. That is where the rubber meets the road on what's kept the institutional investor out of the market. That is starting to alleviate, and I think the Safe Banking Act is going to go a long way to normalizing this market. So what used to be the biggest concern, which was legislative, is not anymore. The biggest concern is execution. Nothing matters more than that. And valuations getting too extended. Because that's what happened throughout 2018 and after the midterm elections of 2018, where we reached record levels in terms of stock prices and valuation metrics going into the first quarter of 19. And as a couple of companies started to report earnings, started up in Canada, the decline in the capital markets, valuation, stock prices, capital availability, which happened in the first quarter of 19, the cracks started to appear in the Canadian LPs. And then it started to drift down into the public MSOs. So overvaluation, investors investing at the highs, companies not properly executing and meeting earnings estimates, that's what created the downdraft that we just came out of last year. That's my biggest concern. And I'm not saying, by the way, that valuations are as excessive as where they were a year ago, because the underlying performance of many public companies is light years better than it was in 2019. governance, execution, modeling, forecasting, strategy. I mean, this market has evolved. But in answer to your question, Andy, it's the industry getting too fluffy, too promotional, too much money flooding into these companies where, you know, money is not going to be made in some of these, you know, highly valued companies unless the execution is perfect. And that's not normally the case. So that's our concern right now is, you know, over exuberance coming back into the market.
You know, I've got another question here around, it's kind of a landlocked business, you know. It can't cross state borders. Financings can't cross state borders as easily. There's all kinds of impediments. As we see an influx of large institutional money, I mean, you know, we mentioned Fidelity, Putnam, Wasatch, and others, you know, this could signal the maturity and advancement of this as a business. And I think, you know, with M&A activity coming along, you know, the dogs in the business are going to be left aside. Those that never set up good corporate governance, those that have intra-dealings, affiliate dealings, and things that are just red flags to the general capital market structure are going to have a difficult time getting around this. But I think as we see that, will we start seeing some easing up on interstate? Will the Fed start doing it? Will some of the clearing firms out there start opening up as their clients start to say this industry is at the point where we're comfortable with doing it going forward with cannabis as an industry and allowing interstate traffic of interstate commerce with funding, et cetera. What do you see coming into this year and maybe into 2022? Do we see a little bit of loosening of the collar and maybe, you know, the exchanges take a different and the regulators take a slightly different view? How do you feel that, at what stage are we at to start seeing some of that open up?
You know, I don't think the politicians and legislators really give a crap about the performance of cannabis companies being better, more predictable, better management. So let's make it legal, and Pershing is going to start clearing cannabis certs, and we're going to be a normal market. I just don't think they care. I think this is a legislative decision that's very much party-based. The party in control right now is light years more pro-cannabis than, you know, the party that was in the White House. I'm not quite sure that Biden is as pro-legalization, descheduling as some of the, you know, more left side of the party. So I think the rollout of legislation is going to be a little bit more modest than what, you know, we hear from some people in the industry, and perhaps what's baked into some stock prices today. As I said before, you know, we hope and pray that the Safe Banking Act is the first piece of legislation that gets passed through the House again for the third time, makes it to the Senate for the third time, and actually gets to a vote, because I think the vote will be yay, yes. And Andy, to us, that is as critical a lever for the institutional investor to go, okay, I'm in the market. You know, maybe second only to legalization. Because the Safe Banking Act, as many on this call know, this is not news, but just from speaking and representing institutions, in their eyes, it makes the cannabis industry kind of more of a normal marketplace. A cannabis company could get a mortgage, they can get a credit line, they can get point of sale card acceptance with merchant banks and credit card issuers. Stuff that's not available to the licensed operator today, because the FDIC insured big banks are not providing commercial banking services to this industry. Once and if they do, a couple of things are going to happen. You have a third source of significant funding, growth capital for cannabis companies. It's not just the equity markets, and it's now not just the debt markets, but it's the commercial banks. It's a big deal. It also provides a less dilutive source of capital, because now you have access to mortgage financing and credit lines, and you can probably see a tightening of spreads in the marketplace. You know, a year and a half ago, the typical note loan to a cannabis company, not a convertible, straight debt, you know, you were seeing coupons in the 16 to, you know, low 20s. in terms of annual interest rates. Convertible notes a little less than that because you have the upside of the convertibility. So you have a lesser coupon, lower coupon. With debt funds coming into the market, we just took down 12% notes from a lender for a couple of our cannabis companies. These are very well-performing companies, by the way, top line and bottom line. But if the FDIC insured banks come in and issue lines of credit, issue mortgage financing, you're going to see a continued decline in the cost of capital on the debt side. So I hope I'm answering your question, Andy. The Safe Banking Act, the MORE Act are the most critical pieces of near-term legislation. In terms of full legalization, I still think that that's a year or two off.
You're answering a lot of the questions. There's still a lot more questions. I don't know if we'll get to all of them. We only have about 3 minutes left until we have to wrap up. But for those of you that did ask questions, all the questions will be delivered to Scott to connect with you on that. I guess in wrapping up this brief webinar we've had on kind of navigating into the cannabis of the future and cannabis financing and the state of the industry, what are your personal top do's and don'ts for cannabis issuers in the market right now? And that could be a broad question. It could be in terms of valuation, in terms of execution. What would you say to cannabis issuers right now as they're coming into market and expanding access to U.S. investors?
So I won't repeat what I've said a few times. That's sort of, commonplace for any business. It's seasoned management that knows how to operate an industry that is extremely dynamic from a legislative perspective, from a state perspective in terms of licensing requirements, zoning requirements, new licenses coming to the market, testing requirements, THC caps. I mean, this ain't easy. It's a very difficult industry to manage through. Real governance, real board, all of that stuff. I would say two other things. Companies are so eager for capital, and now that capital availability is better, certainly than it was a year ago. You can't just take the first deal that comes to you, and you better negotiate a capital injection today with a lender or equity investor that doesn't inhibit the next round or the next round. So you better be careful on dilution in terms and rights of first refusal and warrants, and because I know you need capital today, but you're going to need capital tomorrow. This is a hyper growth industry that is screaming for growth capital. So you just have to keep an eye on the next round or the next round in the round that you're doing and structuring today. I think that's really, really critical. Second to that, or a second answer to your question, Andy, is the exit. And I'm talking obviously for private companies today. The public companies have no issue accessing capital. Maybe we can go to that slide for a second and I'll finish this up. If you can go to slide 14. You could see that public companies have been swallowing the majority of capital in this space. Here's the actual data. But the second answer to your question, Andy, is companies have to prepare and start to plan for and strategize to the exit. One of the things that attracted me to this industry before I started Viridian and since was, and I've banked other new industries. I started the first investment bank in cyber and physical security back in 2002, just a few months after 9/11. So I watched the emergence of that industry. This industry, from the very beginning of when we got in and certainly to today, has a very unusual visibility and likelihood of an exit for the private operator. For the past several years, you can go up to Canada, you could do an RTO on the CSE, you could do an IPO on the TSX or the CSE or the NEO, or you could sell your company. the visibility and predictability of an exit was very unusually strong, in our opinion, for a new industry. I haven't seen this before. So when you go out to raise capital, investors are always looking for, where's my exit if they're investing in a private company, and when is my exit? So when we represent private companies, we do what's called backward planning sequence. We look at companies like our clients that have either sold successfully or have gone public successfully, and we look at how those companies look like. What were their revenues TTM forecasted? What were their margins TTM forecasted? Cash flows, governance, their product portfolio, their scalability. It kind of gives us a cheat sheet of what we need to become to top tick an exit. So to wrap that all up, I think it's critical that you're careful in the money you raise in this round so that it supports and doesn't inhibit next rounds of funding. And secondly, that you build in at an early rather than later stage the exit plan so that you know what you're shooting for so you can provide a return and liquidity for your investors.
Scott, I think that was excellent. There's so much material. We'll have to have a follow-up at some point. I want to thank you and Viridian for joining us in our thought leadership session of OTC markets. I hope we've given you quite a good oversight of what the state of the cannabis industry is. And this presentation will be made available to all registrants. It'll also be housed on our website at otcmarkets.com within the next day. Scott, thanks for joining us, and glad you can be with us.
Andy, thank you so much. I enjoyed it.
Okay, thank you everybody for joining, and we're now going to be ending the webinar.